What happens when the world starts running out of silver? Not gold, not oil, silver. The metal that most people associate with coins, jewelry, and precious metals investing may actually be one of the most strategically important resources in the modern economy. And yet, while investors focus on artificial intelligence, stock market valuations, and interest rates, a critical story is quietly unfolding beneath the surface of the global economy. A story centered around two countries, Peru and Mexico. Together, these nations account for a massive share of global silver production. For decades, they have served as the backbone of the world's silver supply chain. But today, both are facing mounting challenges that threaten future production. Political instability, regulatory uncertainty, mining disruptions, labor disputes, infrastructure bottlenecks, and declining investment. At the same time, demand for silver is accelerating. Solar panels require it. Electric vehicles need it. Advanced semiconductors depend on it. Data centers consume it. Military technologies use it. Medical devices rely on it. The modern world is becoming increasingly dependent on silver at precisely the moment when producing more of it is becoming more difficult. What most investors don't realize is that silver occupies a unique position in the global economy. Unlike many commodities, it is both a precious metal and an industrial necessity. That means it faces pressure from two different directions: investment demand on one side, industrial demand on the other, and when both begin competing for the same limited supply, the results can be significant. Now pay close attention, because the issue isn't simply whether silver prices move higher. The larger question is whether the world can continue producing enough silver to meet the demands of an increasingly electrified and technology-driven future. And if these trends continue, the consequences could reach far beyond the precious metals market. To understand why this matters, we first need to understand silver's role in the modern economy. Most people think of silver as a store of value, but that perspective is increasingly outdated. Today, silver functions as one of the most important industrial metals on Earth. Think of silver as the electrical nervous system of modern technology. Just as nerves carry signals throughout the human body, silver helps carry electricity throughout the devices and infrastructure that power modern civilization. Silver possesses the highest electrical conductivity of any metal. It also has exceptional thermal conductivity and strong resistance to corrosion. These characteristics make it extremely difficult to replace in many advanced applications. Consider solar panels. Every solar installation requires silver paste to convert sunlight into electricity efficiently. Now consider electric vehicles. Modern EVs contain significantly more silver than traditional internal combustion vehicles because of their complex electrical systems. Then there are semiconductors, data centers, artificial intelligence infrastructure, 5G networks, medical imaging equipment, military electronics, satellite systems. The list continues to grow. Here's where the story becomes alarming. The world is pursuing multiple technological revolutions simultaneously. Artificial intelligence requires enormous computing infrastructure. Governments are investing heavily in renewable energy. Transportation systems are being electrified. Defense spending is increasing globally. Each of these trends independently boosts silver demand. Together, they create a powerful structural force. The real issue isn't demand growth in a single industry. It's the fact that nearly every major economic transformation underway today requires silver. And unlike many industrial materials, there are few practical substitutes that offer the same performance characteristics. That reality is becoming increasingly important because demand is rising, but supply faces serious challenges. Let's begin with Peru. For years, Peru has ranked among the world's largest silver-producing nations. Its vast mining sector has supplied enormous quantities of silver to global markets and has become a critical component of international supply chains. But recent years have revealed a growing vulnerability. Political instability, frequent leadership changes, social unrest, and localized conflicts around mining operations. These issues have repeatedly disrupted production and transportation networks. Mining is a long-term business. Companies invest billions of dollars over decades. They require stable regulations, reliable infrastructure, and predictable operating conditions. When uncertainty increases, investment often slows. And when investment slows, future production becomes harder to maintain. But that's only part of the problem. Many mining regions face infrastructure limitations that can complicate logistics and increase costs. Labor disputes have also periodically affected operations. Community opposition to mining projects has intensified in certain regions. Each individual disruption may appear manageable, but collectively, they create friction throughout the supply chain. And in commodity markets, even small supply reductions can have outsized consequences. Why? Because global industrial systems are designed around steady flows of raw materials. When one of the world's largest producers stumbles, the entire market feels it. Silver markets are especially sensitive because annual production cannot be increased overnight. Lost ounces today are not easily replaced tomorrow. This is where things get interesting. Investors often focus on demand trends while overlooking production risks. Yet history repeatedly shows that supply disruptions frequently become the catalyst that transforms a tight market into a shortage. And Peru represents one of the most important pieces of that puzzle. The Mexico problem. If Peru is one side of the story, Mexico is the other. Mexico has long held the position of the world's largest silver producer. Its mining industry plays a critical role in supplying global markets, but significant challenges are emerging here as well. Over the past several years, regulatory uncertainty has become a growing concern for mining companies. Changes in permitting processes, increased scrutiny of new projects, environmental pressures, and shifting policy priorities. All of these factors can influence future production growth. Now pay close attention. The biggest risk may not be an immediate collapse in output. Instead, it may be a gradual reduction in future investment. Mining projects require years of exploration before production ever begins. Companies must identify deposits, conduct feasibility studies, secure permits, raise capital, build infrastructure. Only then can extraction begin. The process often takes a decade or longer. If exploration spending declines today, the consequences may not become visible for years. But eventually, fewer discoveries translate into fewer new mines. And fewer new mines mean less future supply. This is creating a problem nobody seems to be talking about. Many existing mines are aging, ore grades are declining, production costs are rising, yet the pipeline of major new projects remains limited. Mexico remains a silver powerhouse, but maintaining that position will require ongoing investment and development. Without it, future production growth could struggle to keep pace with rising global demand. And when Mexico and Peru both face challenges simultaneously, the implications become much larger than either country alone. Now we arrive at the heart of the story. The global silver market has been experiencing growing supply pressure. Industrial demand has surged. Investment demand remains significant, yet mine supply growth has struggled to keep pace. Industry reports have repeatedly highlighted silver market deficits in recent years. In simple terms, more silver is being consumed than newly supplied. Deficits can be absorbed for a period of time through inventories and above-ground stocks. But inventories are not infinite. Eventually, persistent deficits begin tightening the system. Here's where the story becomes alarming. Many investors assume higher prices automatically solve shortages. In theory, that sounds reasonable. In practice, mining doesn't work that way. New mines take years to develop. Permitting can take years. Construction can take years. Infrastructure must be built. Capital must be secured. Environmental reviews must be completed. Even if the industry identified major new silver deposits tomorrow, substantial production could still be many years away. And that's creating a problem nobody seems to be talking about. The real issue isn't simply current production. It's future production capacity. Adding to the challenge is the reality of declining ore grades. Many of the richest deposits have already been mined. Companies increasingly process larger volumes of rock to produce the same amount of silver. That increases costs and complexity. Meanwhile, a large percentage of silver is produced as a byproduct of mining other metals such as copper, lead, and zinc. This means silver production cannot always respond directly to silver demand. If copper or zinc producers reduce activity, silver supply may decline even when silver demand remains strong. The result is a market with limited flexibility, rising demand, constrained supply, long development timelines, and growing dependence on aging mining assets. Those conditions create the foundation for persistent market tightness. One of the most powerful drivers of future silver demand is the global energy transition. Governments around the world are investing hundreds of billions of dollars into renewable energy infrastructure. Solar power sits at the center of many of these plans, and solar power requires silver. As countries pursue ambitious decarbonization goals, solar installations continue expanding at remarkable rates. Every new panel requires silver. Every new solar farm increases demand. But solar is only one piece of the equation. Electrification is spreading across transportation systems. Electric vehicles require significant quantities of conductive materials. Charging networks require them. Grid modernization projects require them. Energy storage systems require them. What most investors don't realize is that these trends are largely policy-driven. Governments are actively encouraging adoption through subsidies, regulations, tax incentives, and strategic investments. That means demand growth is not solely dependent on market conditions. It is increasingly supported by national policy objectives. This creates a structural challenge. Even if economic growth slows temporarily, many long-term electrification projects continue moving forward. As a result, silver demand may remain stronger than many analysts expect. So what happens if these trends continue? Let's consider three possible scenarios. Scenario 1, mild supply stress. In this outcome, production remains relatively stable while demand continues growing gradually. The market remains tight. Prices trend higher over time. Manufacturers face increased costs, but supply chains continue functioning. Scenario 2, persistent deficits. In this scenario, demand consistently exceeds supply for multiple years. Inventories continue declining. Industrial users begin competing more aggressively for available metal. Price volatility increases. Technology manufacturers face growing procurement challenges. Investors become more attentive to silver's strategic importance. Scenario 3, a major global silver shock. This would require a combination of factors: significant production disruptions, accelerating industrial demand, inventory depletion, and limited new supply entering the market. Under those conditions, silver could become a critical bottleneck for multiple industries simultaneously. Manufacturers may be forced to secure long-term contracts. Technology companies could face rising costs. Renewable energy projects might encounter supply constraints. Investors would likely reevaluate silver's role within the broader commodity landscape. It's important to remain analytical. None of these outcomes are guaranteed. Markets adapt. Technology evolves, new discoveries can occur, but the underlying trends deserve attention because the balance between supply and demand appears increasingly fragile, and fragile systems often produce unexpected outcomes. The silver story is no longer just about precious metals investing. It is increasingly about industrial necessity. Peru faces ongoing political and operational challenges. Mexico confronts regulatory uncertainty and investment concerns. Many existing mines are aging. Ore grades are declining. New projects require years to develop. At the same time, global demand continues expanding. Artificial intelligence, data centers, semiconductors, electric vehicles, solar energy, defense technologies. All of these sectors depend on silver, and each is expected to grow significantly in the years ahead. The real issue isn't demand. The real issue is whether supply can keep pace. History shows that commodity shortages rarely appear overnight. They develop gradually, quietly, almost invisibly, until suddenly they become impossible to ignore. What most investors don't realize is that some of the most important opportunities emerge before the broader market recognizes the underlying trend. Today, silver sits at the intersection of technology, energy, industry, and monetary history. That makes it one of the most strategically important resources in the modern world. The question is no longer whether silver is important. The question is whether the world can produce enough of it. If you found this analysis valuable, subscribe for more deep dives into global markets, precious metals, and the economic trends shaping our future. There is another layer to this story that receives far less attention than mine production or industrial demand: inventories. For years, global markets have relied on above-ground silver stocks to bridge the gap between supply and demand. Whenever demand exceeded annual mine production, inventories acted as a buffer. They helped stabilize markets. They prevented shortages, and they allowed industries to continue operating without major disruptions. But here's where things become concerning. Inventories are not the same as production. Production is renewable. Inventories are finite. Once a stockpile is consumed, it must eventually be replaced, and replacing it becomes increasingly difficult when annual supply struggles to keep pace with demand. Now pay close attention. Not all silver inventories are actually available to the market. Some are held by investors. Some are locked into industrial supply chains. Some are stored as strategic reserves. And some are simply unavailable at current prices. This distinction matters, because a market can appear adequately supplied on paper while remaining vulnerable in reality. What most investors don't realize is that commodity shortages often emerge not because resources disappear, but because accessible inventories shrink faster than expected. When that happens, buyers begin competing for available supply. Manufacturers seek longer-term contracts. Investors increase accumulation. And market dynamics can change very quickly. The real question is not how much silver exists. The real question is how much silver is actually available when demand surges. And that answer may be far smaller than many market participants assume. For much of the past decade, silver has lived in the shadow of other investment themes. Technology stocks dominated headlines. Artificial intelligence captured investor imagination. Cryptocurrencies attracted speculative capital. Meanwhile, silver remained largely overlooked. But that may be starting to change. Institutional investors are increasingly focused on strategic resources. The reason is simple. The world is entering an era defined by physical constraints. Semiconductors require specialized materials. Energy transitions require critical minerals. Advanced manufacturing depends on reliable supply chains, and national security increasingly depends on resource availability. Silver sits directly at the center of these trends. Unlike many commodities, it benefits from multiple demand drivers simultaneously: industrial demand, investment demand, monetary demand, and strategic demand. Few assets possess that combination. This is where things get interesting. Large institutions often begin studying a market long before they commit significant capital. They analyze supply chains. They evaluate production forecasts. They examine geopolitical risks. And they assess long-term demand trajectories. When viewed through that lens, silver presents a unique case: growing technological dependence, rising industrial consumption, persistent supply deficits, and increasing geopolitical uncertainty. None of these factors guarantee higher prices, but together they create conditions that deserve attention. Because the most important investment opportunities are rarely obvious when they first emerge. They become obvious only in hindsight, and by then, the market has often already moved.